market update. Last 2 days have been volatile, pretty crazy. I'm all worked up. So as I've been anticipating for the last 2, 3, 4 weeks, something had to give. I was trying to stay optimistic that yields have gone too far. They're going to have to turn over. We're going to start getting positive inflation news or CPI data. Hasn't come in. Or PMI. The DXY was like reaching possible resistance. It clearly looks like it's going to break through there. What are we at? 104. Like, yeah, we're going to like 106 or 108. That can't be good for the markets. Now, over the last 6 to 8 weeks, the market has melted up. And there's been a lot of rotation into defensive plays such as utilities, materials, financials. Financials is actually supposed to be very bullish for the market. And the Mag 6 has really pretty much gone sideways. Apple and Tesla, if you count Tesla's, really brought it down a lot. Mega cap tech has sold off a bit. Like some of the cloud and data companies have come down. So I thought there could be a reacceleration with mega cap tech, and it just resets like it's been doing for the last year and a half. I don't think we're going to see that. I played that. I gave up on that this morning. And I've just been anticipating, are we going to get like a full market rally and no more rotation, or are we just going to get a full market sell-off? And it looks like it might be a full market sell-off. So I wrote down some notes of things that I want to discuss and what I'm contemplating. So obviously rate cuts have gone from 6 recently to 2, and now given what the markets are doing and what the CME group is projecting, down to 0. Or 0's in play now. Markets look too strong. Employment looks too strong. GDP looks strong. Earnings are going to be strong. Why cut? Why cut? And a lot of stock market analysts are like, fine, they're accepting it, like sticking their chest out. Why? We'll be fine. Okay, we'll see. That's obviously not good for small and mid caps. And a couple months ago, they were arguing we need to see broadening. How are you going to see broadening if we're not creating lower rates or anticipating lower rates? So I think that's an issue. Typically, the time period between a rate cut and the last rate hike is 6 to 9 months historically, or at least over the last 30 to 40 years. Our last hike was July 2023. We're now June's might be getting pushed back, so we could be over a year. Historically, that's pretty long, saying there's a more likelihood of that restriction creating a recession. Now, I don't know if many analysts are mentioning this, but when we've been in these predicaments and they create rate hikes to restrict the economy, to create some kind of recession, to reset everything, have we ever been at 0% interest rates? And I thought recently we've done these cycles and we've gone from 2 to 6, or back in the 80s probably from 4 to 10 to create a restriction. But I didn't even realize from 2007 to 2015, interest rates were at 0% or near 0, like 0.5%. So that was crazy. That's obviously amazing for the markets. But they did try to get ahead of it. Let's see. So yeah, at the beginning in 2016, whoever was the Fed chair then, I don't think it was Powell, started beginning hiking and probably anticipating inflation getting insane after having pretty much 0% rates for 8 years. About 8 years. And they brought it up all the way to almost 3% or 2.5%, and then the pandemic happened and they made the bad decision, and then inflation went nuts. So they tried to put a cap on it, and the pandemic just ruined that. And so what I'm contemplating is bringing from zero. Like, it looks pretty obvious that a baseline should be 2 to 3%. I almost see no reason why was it ever 0. So baseline should be 2 to 3. So if you want to create restriction, you got to go to like 6. And we're at 5 1/4. So can 5 1/4 in how strong this economy is and the transition into AI and productivity and higher growth output, is that restrictive enough? I don't know. There's really no history behind that. So that's what I'm contemplating, that keeping rates at this long should create a recession, but if we're coming from 0 to maybe 5.25 isn't a big deal. So I don't know. I don't think it's very possible we don't cut till the end of the year, and if not till 2025, and I'm contemplating, can a recession happen? I think I mentioned this, the last 2 months there's really just been a rotation. We've seen kind of a melt up, but it's like the markets have pretty much topped. I think to create new legs, we needed inflow from institutional money or whale money back into mega cap tech. I was anticipating that. I've been in semis for like 2 to 3 weeks. It didn't really happen. So that's what I thought needed to happen for us to have another leg up to 5350 or 5400 on the S&P. The NASDAQ has more room to go, but money didn't come back into mega cap tech. They must think, or at this point I'm assuming they think it's overbought. The RSI levels are just too high. They need to reset. Okay, so but also in a bullish sentiment is Q4 earnings were mixed to possibly even weak compared to the last 3 or 4 earning calls. Many companies, and this kind of happened so that's why I'm beginning to think this year can match next year, but just different percentages, but kind of the same results seasonality wise. So many companies brought down their yearly guidance, and valuations of those companies sold off maybe because of that. But as 2023 went on, they beat and no recession happened, and many companies soared because of it. So a lot of companies set the benchmark fairly low, anticipating some kind of recession, consumer weakness, and if that doesn't happen this year and GDP stays strong, they're going to continue to crush just like 2023, pretty much across the board besides small cap companies. So that's a positive factor in this playbook. We've got Q1 earnings coming up, I think starting next week. So we'll see if that comes out pretty strong. We'll see if GDP can continue to be strong. But to wrap it up, I was looking last year, we obviously very similar to this year. January was very strong. February was, the first 2 weeks of February 2023 was explosive. We come back down, I'm looking at the NASDAQ, 3 to 5%. We go sideways throughout April. So that's possible this year, even though many analysts are because March was mixed, right? April seasonality is strong, very strong. And I was kind of buying into that. I'm March didn't happen much. Not much happened. I wanted to see another leg in this market, and I thought it would come back in mega cap tech. So the play might even be April's going to be sideways, even though seasonality says it's strong. Then if you look at May 2023, explosive. June 2023, explosive. So I don't think we can see the same gains as we did last year since we're such at high levels already. And I think whatever pullback we do see in April might be minimal, 5 to 7%. So I don't know, we could attack 5,400, 5,500 by the end of June. Then if you go to the playbook from 2023, from August to the end of October, for about 3 months, at least the NASDAQ dipped 10 to 15%. This time I think it could be even more, because we're going to be so overbought by then. So overbought. I'll have to look at the number. It might only be 7 to 10%, but I'm expecting whatever 2023's results were, that this year will be more. So if last year was 7 to 10%, this year could be 10 to 15. If last year was 10 to 15, this year could be 15 to 25%. But the end of the year could be strong. Still, that's so far forward. I don't know what. I assume we're going to start cutting then. I assume we're not going to have a recession then. I assume that GDP will be pretty strong. So it'll actually be a little surprising that they cut, but they'll probably just be like, oh, we're at a year and a half already. Like, might as well bring it down back to, like, I think a base is like 2 to 3% is if you want growth. 3 to 4% interest rates is like kind of will be the norm for a while. So yeah, that's my review.